Hello, this is Finoptio. Today we're going to learn about one of the building blocks of wealth: leverage. Leverage is so essential to maintaining and growing wealth that it's used by all wealthy people. If you take a look at the real-time world wealth rankings found on Forbes, you'll see that all of the people at the top use a leveraged strategy called publicly traded companies. If we look at the 2024 Korean Wealth Report, published by KB Financial Group in South Korea, we can see that the total debt-to-assets ratio for people with more than 10 billion won in assets is 87%. The rich are very fond of the leveraged strategy of borrowing. You can even see that this debt-to-asset ratio rises as the size of the asset increases. Rich people love to use the leverage strategy of debt to buy assets. By the end of today's video, you'll be able to eliminate your fear of leverage and understand that it's an essential tool for getting into the wealthy class. And I hope you'll make the effort to understand everything in the video, because you'll learn all about leverage and make your chances of becoming wealthy even better than before. What is leverage and why has it become a must-have strategy for the rich? First, let's define leverage. We define leverage as a wealth accumulation structure that allows you to significantly increase the size of your expected returns by acquiring additional resources to compete at relatively little cost. Let's look at some classic examples, the first being the hiring of mercenaries in war. The resource needed to fight a war, military power, is very difficult to grow quickly. It takes a lot of time and effort to grow an army. In this case, the number of enemy countries that would benefit from being invaded is limited by your current military strength. At this point, we can consider the option of hiring mercenaries. If the demand for mercenaries is low because wars are infrequent, and the supply of mercenaries is high because there are a large number of trained mercenaries from around the world, we can hire a large number of mercenaries at a relatively low cost, which is a necessary resource for warfare. Our options then become very wide. The number of enemy countries we can invade increases, and the size of the military gains we can expect increases dramatically. In this way, hiring mercenaries fits the very definition of leverage. The next example is a franchise business. Running one restaurant on your own is very time-consuming and labor-intensive. You can't even dream of running two restaurants. But let's say you run a restaurant by yourself and it does very well because of your unique recipe. Then you get a lot of people who want to know your secret. So if you just create a manual that tells them how to run the restaurant, you can get a lot of people who will run the restaurant for you and make money. It doesn't cost me much to get people to work for me. Now, in exchange for my manual, I have a bunch of restaurants that run their restaurants according to the manual and pay me a huge franchise fee. Now, I don't have to laboriously run the restaurants myself. Franchising is a classic example of leverage because I've increased the size of my expected profit by acquiring additional resources at a small cost. Investing with a loan is also an example of leverage. Let's say I currently have $100. If I made an investment with an annualized return of 20%, my annualized return on my investment is $20. I invested $100 and earned $20, so my return on equity is 20% per year. Now let's take out a loan. I'm a very creditworthy person. The bank gives me a credit loan of $400 at 5% interest. Now I have a total of $500 that I can invest. I again invested in an asset that earns 20% return. Now my return on investment is $100. Meanwhile, the interest rate on the loan is 5%, so I incurred $20 in interest costs. My final return on my investment after interest expense is $80. Now, what is my return on equity? It's 80% because I only invested $100 of my own capital and made a final return of $80. That's a whopping 4 times the return on equity of 20% if I invested without a loan. This is a classic case of leverage, because I borrowed at a low interest cost based on my high creditworthiness, and I got a loan that was 4 times my equity, so the size of my profit and my return on equity became very large. All the rich people are doing it, and with the obvious benefit of greatly increasing the size of your expected returns, why aren't more people considering leverage strategies? I think there are 2 reasons. One is because it's scary. In the short term, leverage is a strategy that increases the size of your expected returns, but it also increases the size of your expected losses. For example, if you hire mercenaries and you don't win the war and you lose, it's not just the loss of your own military power, it's the cost of the mercenaries, so the magnitude of your loss is huge. Even if you use leverage, you don't have the confidence to win, and the magnitude of your losses in the event of defeat is very large, so you're understandably scared. The second reason many people shy away from leverage is that they don't know they need it. A lot of people want to be rich. By wanting to be rich, we mean to move up the ladder of affluence from where we are now, consistently increasing our ability to get what we want when we want it. In order to move up the wealth scale and stay there, leverage is a must. It's not optional. So my goal today is to get you excited about leverage by helping you realize that it's an essential component of wealth and that there are ways to get rid of your fear of it. To achieve today's goal, I want you to realize 3 things, and the first is that the rate of return you need to become wealthy is much higher than you think. The second is that you need high returns, but the problem is that high returns necessarily come with high risk. The third is that there is a way to run a leveraged strategy reliably over the long term with a 0% chance of failure. Once you learn these 3 facts, you'll realize that leverage is a must and your fear of leverage will disappear, making leveraged strategies a must-have. Let's learn them one by one. The first fact we need to know about the necessity of leverage is that the rate of return we need to get rich is much higher than we think. We've recently seen inflation at an intensity we haven't seen since the 1980s, so many people are realizing that inflation can make life difficult even if they stand still. But I don't think they have a very concrete sense of how much return on their investments they need to beat inflation and stay wealthy. To get a rough sense of the investment returns needed to move up the ladder of affluence, let's look at an example. Let's calculate the rate of return needed to move from middle class to wealthy in the United States without a single asset to inherit. First of all, according to a survey by the U.S. financial group Charles Schwab, Americans generally need to have a net worth of $2 million or more to feel wealthy. Using this as a guide, let's calculate the approximate return on investment needed for a middle-class American to own a home worth about $2 million. Let's assume your annual income is $100,000, which is slightly above the median U.S. income. Your savings rate is 20%, which is very high compared to the average U.S. savings rate, which is only in the single digits. Your income and consumption are assumed to grow at 3% per year. Let's assume that the current $2 million home you want to buy appreciates at an average of 5% per year. For reference, U.S. residential real estate appreciates at an average of 5 to 6% per year over the long term. Let's assume that you invested all of your savings in the S&P 500 ETF, which has consistently earned an 8% annualized return. Your target property is appreciating at 5% per year, your assets are appreciating at 8% per year, and you're saving more than $20,000 per year, so you think you'll be able to buy your target property someday. But the reality is different. This is a graph that shows the price of your target property and your wealth situation every year using the assumptions I mentioned earlier. The dark blue graph is the real estate price by year, and the light blue graph is your assets saved by year. With the assumptions I mentioned earlier, you won't be able to buy your target home for another 50 years. Starting in year 42, the rate at which your assets are growing exceeds the rate at which your target real estate price is growing. But in year 50, your assets are still about $4.8 million short of buying your target property. As we've shown in previous videos, it's no easy task to generate investment returns that are comparable to the long-term average annualized return of the S&P 500, which is 8% per year. Even the elite group of Wall Street fund managers underperform the S&P 500 about 85% of the time, looking at the last 10 years. Even if we earn a very good 8% annualized return on our investments, we will most likely not achieve our goal of entering the wealthy class in our lifetime. The things that the already wealthy consume, such as luxury homes, are very expensive, and even the rate at which they are rising is much faster than the general rate of consumer inflation. It takes something different to catch a bird that's already flying high and rising fast. Now let's calculate backwards what percentage return on investment you'd need to buy your target home within 10 years under the same conditions. That rate of return is a whopping 56%. You'd need to earn an average annualized return of 56% over 10 years to buy your target property in 10 years under the conditions I mentioned. That 56% compounded annualized return is actually not possible by ordinary means. The chart I'm showing you is a chart that shows how many percentage points Warren Buffett, George Soros, and other masters of investing have beaten the S&P 500 index over their investment horizons. The x-axis is the investment horizon, and the y-axis is the degree to which they beat the S&P 500 over their investment horizon. As you can see, once the investment horizon exceeds 20 years, most of the masters are limited to outperforming the S&P 500 by a range of 0% to 20%. Depending on the time period, the S&P 500's 20-year average annualized return is roughly 7 to 8%, which means that even the best investment masters in the world can't outperform the S&P 500 by more than 30% per year. So to give you a sense of the return on investment to get into the wealthy class, the 56% annualized return that we've calculated is an impossible return. We need to realize that if we want to go from middle class to wealthy, we need to do something special. At this point, some of you may be thinking, isn't it possible that real estate is entering a long-term decline? Or why not use other goods and services as a benchmark for getting into the wealthy class, instead of real estate? But no matter what happens, it doesn't change the fact that your ticket to wealth is like a bird that flies high and flies fast. To understand this, we need to understand inflation. How are prices determined? Prices are calculated by dividing demand, calculated as the money supply multiplied by the velocity of currency circulation, by output. Money supply is the total amount of fiat currency in circulation in the market. The velocity of currency circulation is how many times a unit of currency is used to purchase goods or services during a given period of time. This is not a very important variable in the long run, as it usually ranges from 1 to 2, with no significant long-term movement. Money supply multiplied by the velocity of currency circulation equals demand, which is the total amount of money used to purchase goods or services over a specific period of time. The total amount of goods or services produced and put on the market during a given period is called output. Prices, calculated this way, rise forever in the long run. Why does this happen? There are many reasons, but here's the most fundamental: the money supply is free to grow by social consensus, whereas output is limited by the constraints of reality. In simple terms, money supply can go from $100 today to $1,000 tomorrow, as long as there is social consensus. It can grow freely at any time as long as there is social consensus. Moreover, economic participants all have a strong bias in favor of increasing money supply. Do you like governments and central banks that make it easy to borrow? Do you like governments and central banks that make it difficult to borrow freely? Because politicians, people, and businesses all have a bias in favor of governments and central banks that make it easy to borrow, money supply tends to keep growing unless something special happens. On the other hand, there are realistic constraints on the infinite growth of output. All goods and services are produced and sold with a combination of labor, capital, and technology. No matter how much people want to, if there is a shortage of labor, capital, and technology today, output can't just increase tomorrow. You can't build a house tomorrow if there is a shortage of houses today, and you can't have a hospital near you tomorrow if there is a shortage of hospitals around you today. Since the quantity of money grows indefinitely by agreement among people, and output rises slowly by realistic constraints, prices can only rise in the long run. There are two important points here. One is that the more scarce goods or services that are difficult or impossible to increase production of, the faster prices rise. And these are usually the things that the wealthy already consume or want to consume when they become wealthy. The second is that if those with the purchasing power buy a particular good or service early and thus reduce the amount of it on the market, those who are behind are forced to pay more for the same thing. Because of these 2 points, the ticket to the wealthy is already flying high, and it's flying higher very quickly. Whatever it is that you want to consume as a wealthy person, whether it's a luxury watch, a bag, a car, jewelry, real estate, cryptocurrency, a degree from a prestigious university, whatever it is, those things are hard to produce and the wealthy are buying them first. They're already priced high and they're going up even steeper. If you want to be wealthy, it's not the general consumer inflation rate that matters, it's the inflation rate of these scarce and valuable things. So no matter what your measure of wealth is, or even if real estate prices are on the decline, it's hard to escape the structure that I've described. If you start at the middle class level and you want to get into the wealthy class, you need to have a tremendous rate of return. We need to competitively outperform others to get into the wealthy class. So that's the first thing I want to talk about. The second fact is that high returns necessarily come with high risk. We have to chase high returns to get rich, but we have to recognize that high returns necessarily come with high risk. Only by solving this problem can we find a way to get into the wealthy class. Why does high return necessarily come with high risk? To understand the relationship between risk and return, you need to understand the concept of a perfectly competitive market. A perfectly competitive market is one that meets the following 6 conditions. The first condition of a perfectly competitive market is a large number of market participants. In a perfectly competitive market, there are enough sellers and buyers that no individual seller or buyer can have an absolute influence on the market price. Also, this large number of participants prevents a situation from arising where a transaction cannot take place due to a lack of buyers or a lack of sellers. The second condition is homogeneous goods and services. In a perfectly competitive market, the goods traded are all of the same quality. Therefore, buyers choose which product to buy based solely on price. The third condition is equal information. All market participants have equal information. Since there is no information gap between the participants, it is difficult for one side to gain an advantage in a transaction. The fourth condition is free entry and exit. All market participants are free to enter and exit the market without economic, legal, or technical barriers. The fifth condition is that market participants are all price takers. No one has the will or ability to adjust prices. All participants accept the prices formed in the market as they are. The sixth condition is that there are no transaction costs. No one is prevented from participating in the market because it takes a long time to negotiate a deal, a long time to find information, or because transaction fees are high. A market with these 6 conditions is called a perfectly competitive market. What does this market look like? Let's take a look at a perfectly competitive market for hamburgers. Currently, the price of a hamburger is $10. Everyone agrees that this hamburger has a fair value of $10 because this price was formed by a consensus of many people who all have the same information about this hamburger. What would market participants think of me if I suddenly claimed that this hamburger is actually worth $8 and that I would like to buy it for $8? Not a single person would sell me the hamburger for $8, because there is no reason to do so. No one would be fooled by the lie that the hamburger is actually worth less than the market price, because all market participants have the same information. And there are plenty of buyers in the market who would buy the hamburger for $10, so there is no reason to sell me the hamburger for $8. In other words, prices in a perfectly competitive market accurately reflect value, and there is no way you can buy something for less than its value. Now let's consider the case where the stock market is a perfectly competitive market. A stock is currently trading for $10 on the market. Because this stock market is a perfectly competitive market, it means that the fair value of this stock, negotiated by all market participants with the same information, is $10. No matter how much I claim that this stock actually has significant risk and that its fair value is $8, there is not a single person who will sell it to me for $8. No one is fooled by my lie because the market price, which is the result of everyone negotiating with the same information, is very smart. The collective intelligence expressed by the market price is very smart. So if the stock market is a perfectly competitive market, then the market price of the stock we see is always the fair price. There is no opportunity to buy undervalued stocks. The only way to beat the overall market over the long term is to consistently buy undervalued stocks, but since you have to buy only fairly valued stocks every time, no one will ever beat the overall market's performance over the long term. Now let's ask an important question: is the stock market in the real world anything close to a perfectly competitive market? Or is it closer to a perfect monopoly? A perfectly monopolistic market is the opposite of a perfectly competitive market. It's a market where there is an absolute power player in the market, and that power player sets the market price and also monopolizes the profits of the entire market in a discriminatory way. What is the stock market similar to? In the real world, stock markets are not 100% perfectly competitive, but they are very close to being perfectly competitive, and there is a lot of evidence to prove it. Let's revisit what we mean when we say that the stock market is a perfectly competitive market. As I mentioned a moment ago, a perfectly competitive market is one in which homogeneous goods and services are traded. For example, if the market for trading hamburgers is a perfectly competitive market, it means that the hamburgers being traded are all of the same flavor and quantity. This is because hamburgers are a product whose demand is driven by flavor and quantity. What does it mean for stocks, on the other hand, to be homogeneous? Stocks are investment products that are traded because they give you a return in exchange for taking on risk. So the implication of stocks being homogeneous is that all stocks have the same risk-to-return ratio. If we graph this, it looks like this: in a perfectly competitive market, all stocks have different risks and different returns. But they all have the same ratio of risk to return, which means that if you pick a stock with a lower return, you have less risk of losing money, and if you pick a stock with a higher return, you have more risk of losing money. If you've gotten this far, you can probably imagine what the stock market would look like if it were a perfectly competitive market. In the short run, people who pick stocks with similar risks to C might have very high returns. For example, if they had a 70% chance of losing money, but were lucky enough to avoid this probability, they would have a much higher return at any given time compared to people who picked A or B. However, the longer the investment horizon, the more likely it is that the return on investment will be the same whether you pick A, B, or C. This is because those who pick C will make more money than others when they do, but they will also lose money more often than those who pick A or B. In the end, an important characteristic of a perfectly competitive stock market is that the act of picking a stock is not very meaningful. To make it a little easier, think of flipping a coin. Imagine you're playing a game where you win if you land a lot of heads. The first 1 or 2 times, there's a clear winner and a clear loser. But what if you flip a coin 1,000 times? What if you flip it 10,000 times? The more times you flip it, the closer everyone in the game will get to a similar number of heads. The essence of the 50% chance of landing heads is something that reveals itself over time. In other words, if the stock market is similar to a perfectly competitive market, there will be clear winners and losers when the investment horizon is short, but over time everyone will have similar returns. Now let's look at the stock market in the real world. This figure shows the percentage of large cap funds in the US that beat the S&P 500 index over the past year. Over a short investment horizon of 1 year, 43% of funds beat the S&P 500 index. If we increase this time horizon to 5 years, the percentage of funds that have outperformed the S&P 500 drops to 23%. If we increase this time period again, this time to 10 years, it drops to 15%. As we increase the time horizon, the percentage of funds that beat the overall market returns decreases. This is characteristic of a typical perfectly competitive market. It's no surprise that the stock market exhibits the characteristics of a perfectly competitive market. As modern stock markets have gone online and are increasingly open to other countries, there are so many market participants. The information gap between market participants is also shrinking with the development of media, especially since, unlike in the past, the law strictly prohibits trading using corporate insider information, so the information gap between market participants cannot be completely eliminated, but it is shrinking. Free entry and exit is also a characteristic that is becoming increasingly stronger. As capitalism progresses, a lot of surplus capital accumulates, and a lot of this surplus capital is invested in risky assets. This trend is only going to get stronger, so if you have an idea, it's going to be easier and easier to start a business and get it listed on the stock market than it was in the past. Similarly, exiting the stock market is also getting easier and easier as the history of capitalism progresses, because many companies are building up their M&A capabilities. Because of the aforementioned characteristics, the room for any one individual or group to manipulate prices has been greatly reduced. Many stock market participants enter into transactions with an attitude of acceptance of the market price. Transaction costs are also decreasing due to the development of media and competition among brokerage firms to reduce transaction fees. We are living in a world where many people can easily obtain information about stocks and trade stocks around the world at low transaction costs. The conditions described above are increasingly ensuring that stock prices are fairly priced given the risks and expected returns. To some extent, these 6 conditions are met, which is why real-world stock markets, while not perfect, exhibit the characteristics of a perfectly competitive market. Of course, as I said, there is some evidence that the market is not 100% perfectly competitive. First of all, there are certainly some investors who have outperformed the overall market over the long term. The fact that there are a small number of technicians who can flip a coin tens of thousands of times and still get more heads than tails suggests that this is not a 100% perfectly competitive market. But you only have to look at the data from some of the world's greatest investors to see that the stock market is close to a perfectly competitive market. There are some outliers, like George Soros and Warren Buffett, but by and large, the longer the investment horizon, the less they outperform the market and the more similar their returns become. What this means is that even the best investors in the world can't outperform the overall market by a huge amount over a long period of time. So what we're saying is that the stock market is not 100% perfectly competitive, but it's close to perfectly competitive. Now you should be able to understand this graph. Investments with very high expected returns necessarily have high risk. If we want to be wealthy, we need very high returns, and in pursuit of that, there is necessarily high risk. We need to solve this problem to get into the wealthy class. The third thing I want you to know is that there is a way to reduce risk while chasing high returns, and it's a good thing. Many people use it to get into the wealthy class earlier than others and stay wealthy. How do they do that? There are 2 things you can learn to lower your risk while chasing high returns. The first is how to win in a complex world. The second is how to operate leverage reliably. Let's take a look at each one. Earlier in the video, we learned how leverage can be used to turn a 20% annualized return into an 80% annualized return. So there are 2 challenges left. The first is that we need to reduce the probability of failure to close to 0%, because when you use leverage, the losses are too large if you fail. The second is that when you use leverage, like a loan, there's usually principal and interest that you have to pay back every month, and there's a maturity date when you have to exit the leveraged strategy. When you use leverage, you're adding a set of rules to the game, and you have to learn to win within those added rules. Fortunately, there is a way to solve these two problems. The first piece of knowledge you need to understand how to do this is how to win in complex systems. We've already learned about the basic principles needed to win in complex systems in the last video. If you don't know about this, you should definitely learn about how to win in a complex world via the link in the top right. As we learned, simple systems have a simple structure of cause and effect, so it's easy to determine the cause of an effect by observing just a few phenomena. Complex systems, however, have a very complex structure of cause and effect. By looking at a single phenomenon, the full structure of cause and effect can never be grasped by the human mind. So you need to formulate a few strong hypotheses and then observe a large number of phenomena that fit those hypotheses over a long period of time to identify the key factors that influence the outcome. Then applying the key factors you found and sticking with it for a long time, no matter what, is the basic structure of how to win in complex systems. Of course, in a complex world, there are too many factors affecting a particular outcome and too many relationships between them, so even if you find the key factors, you won't always succeed. But even when you don't succeed, you must remain steadfast in your strategy, and over the long term, the true value of your strategy will begin to show in your results. Of course, the ability to find the key elements is important. But what's even more important is sticking with a particular strategy for a long time without changing. Let's look at a strategy that invests in the S&P 500 ETF. What this strategy means is that you're going to invest in 500 large-cap stocks that are representative of their industries, as selected by the global market research firm S&P. It's a pretty good strategy that will give you average performance of the overall market, but it's not a great strategy. This is because there are many other factors that have a much more positive impact on stock price expected returns than the representative large-cap stocks by industry factor. But even a decent strategy of buying S&P 500 ETFs can reduce risk dramatically if you stay the course. The chart you see shows the total return of the S&P 500 assuming you reinvested all the dividends you received. Naturally, depending on when you invested, you'll have some years where you lose money and some years where you make money consistently. Based on this data, we can calculate the likelihood of losing money if you chose your investment timing at random, by investment period. Here's the result. If an investor started investing at a random point in time and invested for 3 months, there is a 33% chance that the return on their investment would be 0% or less. The probability of this investment failing decreases as the investment horizon increases. Then, if you increase the investment horizon to 15 years, the probability of investment failure drops to 0%. In other words, even a very unlucky investor who started investing right before the financial crisis would have a 0% chance of investment failure if they simply increased their investment horizon to 15 years. And that's with a strategy as simple as diversify among representative large-cap stocks in each industry. If you learn a good strategy that takes into account valuation, price momentum, shareholder returns, and more, you can reduce your investment horizon from 15 years to 5 years to achieve a 0% chance of failure. You'll learn about these strategies in the coming days. So we can create a 0% probability of failure by simply choosing a good strategy and sticking with it for a long period of time. We've solved the problem of reducing the probability of failure. We just need to find the right strategy and stick with it for a long period of time. The better strategy we find, the less time we have to wait. The remaining challenge is how to overcome the constraints of principal, interest, and maturity that come with leveraging. This is harder than you might think without learning. For example, what happens if you take out a loan with a 1-year maturity? You need to maintain your investment strategy for at least 5 years, but after 1 year, it's impossible to maintain your investment strategy because you'll have to pay off the loan. In this case, the probability of failure of the leveraged strategy is very high. Or what happens if you borrow too much and the principal and interest you have to repay each month is too large compared to your monthly income? In this case, you will also end up exiting the investment quickly, unable to overcome the pressure of repaying the principal and interest. Or what happens if you invest all your capital and loans without leaving enough spare cash? Over the course of a 5-year or longer investment horizon, there are many things that can happen that can cause you to suddenly need to spend a lot of money. A family member might get sick, you might need to buy a car in a hurry, you might get married, you might move, or you might need to buy a house. 5 years or more is a long time for anything to happen, so it's also important to make sure you have enough cash on hand. It's a lot harder than you might think to run leverage reliably for a long period of time, so I would recommend learning all the caveats and running a leveraged strategy. Once you've learned how to win in a complex world and how to run leverage reliably, you'll be able to overcome the downsides of leverage. I've used stock investing as an example, but the principles are the same in any field. People who understand these two things quickly become wealthy, raising the price of scarce goods and lowering the purchasing power of others. This is the case with all the rich people we've seen who started public companies. They found the right strategy, stuck with it for the long haul, and leveraged it reliably for a long time. With a superior method of raising capital that has no principal and no maturity, publicly traded stock. Similarly, the rich people in South Korea got rich because they stuck to a strategy of owning real estate in a growing country that was in short supply, and they leveraged it for a long time with a long maturity loan product called a real estate mortgage. So if you've gotten this far, I think we've accomplished the purpose of this video that I mentioned at the beginning of the video. I trust you understand that leverage is a necessity, and that the only reason you're afraid of leverage is because you don't have the knowledge you need. So far, we've learned about the components of wealth, liquidity, credit, and we've completed our study with the third component, leverage. Next time, we'll cover the final topic in the Components of Wealth series, cash flow, and I want you to remember that we're learning more about the components of wealth in order to refine our goals and understand what the right vehicles are to achieve those refined goals. If you enjoyed today's video, please subscribe to the FinOptio channel. And I'd also like to invite you to visit our website through the first comment or through the channel information. You can find more educational content there. Thank you.